Firms invest in real assets and finance the investment by selling financial assets. The firm's investment and financing decisions require the valuing of assets. Why does an asset have value? An asset has value because an asset provides a return on investment in the form of future cash payments. These future cash payments comprise the asset's cash flow stream. What's valued about an asset is its cash flow stream. So to value an asset, we assess the value of its cash flow stream. And the value of an asset is the present value of its cash flow stream at its opportunity cost of capital. Present value is the amount of money needed today to replicate a cash flow stream in the financial market. We would pay no more for an asset than the amount of money needed to replicate its cash flow stream in the financial market. Valuing an asset as the present value of its cash flow stream is called discounted cash flow valuation. Present value results from the time value of money. Money is time value. $1 today is worth more than $1 tomorrow. The time value of money is the rate of exchange between present dollars and future dollars. It's reflected in the rates of return available to investors in the financial markets. Picture the financial markets as a place where dollars are traded across time. The rates of return in the financial markets move dollars across time to establish their values at various points in time. Let's look at moving dollars across time to establish their future values and present values. We'll begin with future value. Compounding is a process by which future values are created. Compounding moves a present value into future periods to determine its future value. It answers the following practical question. If I invest a fixed sum today, how much will I have at some future date? Let's look at the process of creating future value through compounding. Suppose we invest $1 at an annual compound rate of interest of R%. Interest is received at the end of the year. At time 0, we invest $1 and earn a return 1 year later at time 1. The future value at time 1 consists of the original principal and interest earned on the principal. Interest earned on principal is called simple interest. The $1 principal is common and can be factored out to give this equation. The future value of $1 invested for 1 year at an annual rate of R% is equal to $1 times 1 plus R. Now let's reinvest this entire sum we have at the end of time 1 for another year. The year 1 sum is invested again to earn a rate of return over year 2. The future value of $1 invested at an annual rate of R% for 2 years is equal to $1 times 1 plus R squared. Let's multiply this out. We obtain the component parts of the process that created this future value in year 2. We had the original principal. We invested for 2 years, so we have 2 years of simple interest, interest earned on principal. In addition to simple interest, the return now includes another item, R squared, interest earned on previous interest, interest on interest. Interest on interest is called compound interest. So when we invest at compound interest, the period's return consists of simple interest and compound interest. Compounding is earning interest on interest. Now let's reinvest the entire sum we have at year 2 for another year. and earn a return over year 3. We can see the emerging pattern and generalize the equation to obtain the standard equation for future value. The future value at time t is equal to the cash invested at time 0. This is also the present value. We multiply the present value by a future value factor. That future value factor consists of the interest rate per period and the total number of periods over which the cash is invested. By period, we mean compounding period. A compounding period is the interval of time over which compounding occurs. With yearly compounding, compounding occurs once a year at the end of the year. In this lecture, we'll initially be working with yearly compounding, but compounding may occur more frequently than just once a year. Semi-annual compounding compounds interest twice a year, every 6 months. Quarterly compounding 4 times a year, every 3rd month. Compounding may also be monthly or daily. Compounding can even be continuous. We'll look at other compounding periods later in the lecture. Let's put some numbers in our example and invest $100 at an annual compound interest rate of 10%. Compounding is earning interest on previous interest, and compounding is the process by which future values are created. In this graph, we've invested our $100 at 10% per year for 20 years. The columns are the future values at the end of each year. The green is our $100 principal. The portion of the columns above this is the future value created. The blue is the amount of future value created by simple interest accumulated over time. The red is the amount of future value created by compound interest accumulated over time. The yearly change in the height of the columns is a dollar return over the year, and it consists of simple interest and compound interest. In our example, simple interest is contributing just $10 per year. Compound interest is contributing an ever-increasing amount each year. The contribution of simple interest becomes relatively insignificant by comparison. As this graph illustrates, compounding is the driving factor in the creation of future value. Let's look at a numerical example. Suppose you invest $7,000 in a 5-year CD earning 6% per year. How much would you have in 5 years? We'll solve this problem first using the mathematical equation, and then we'll solve it in an Excel spreadsheet. At time 0, we invest $7,000 at 6% per year. We want to know how much we will have at the end of 5 years. We'll solve this using the future value equation. The future value at time t is equal to present value times 1 plus the rate of return raised to the tth power, where t is the total number of periods over which the investment is compounded. And so, the future value at the end of 5 years is equal to a present value of $7,000 times 1 plus a 6% rate of return raised to the 5th power. Given yearly compounding, there are 5 compounding periods over 5 years. Doing the math, our future value factor is 1.3382, and our future value at the end of year 5 is $9,367.58. So if you invest $7,000, earning 6% per year, at the end of 5 years, you'll have $9,367.58. Now let's solve the problem in a spreadsheet. The time value of money formulas in Excel use 5 inputs that correspond to inputs and outputs for many common time value of money problems. Rate is the interest rate per period, input either as a decimal or as a percentage. And per is the number of periods. PMT is the amount of a recurring payment in an annuity. We'll cover annuities later in the lecture. PV is present value. FV is future value. Let's input our values. We input 6% into rate, 5 into number of periods, and we input a negative $7,000 into present value. The spreadsheet solves for future value and gives us a positive $9,367.58. What about these positives and negatives? Take the decision maker's point of view and think of this as the decision maker's cash inflows and outflows. The example is an investing problem. When you make an investment, you pay out a present value in order to get a future value. When you make an investment today by purchasing an investment asset or by making a payment into an account, this is a cash outflow from the decision maker's point of view. So the present value in an investment is negative. Cash income you receive from the investment is a cash inflow from the decision maker's point of view. So future value in an investment is positive. Now consider the case of borrowing. When you take out a loan, you obtain a present value by paying out a future value. When the lender gives you the proceeds of the loan, this is a cash inflow from the decision maker's point of view. So present value is positive in the case of borrowing. When you make a loan payment to the lender or repay the loan's principal, this is a cash outflow from the decision maker's point of view. So future value is negative in the case of borrowing. So always consider the inflows and outflows of cash from the decision maker's point of view. Now let's go to the spreadsheet. Suppose you invest $7,000 in a 5-year CD earning 6% per year. How much will you have in 5 years? Our rate is input either as a decimal or as a percentage. Let's input it as a percentage. Number of periods. There are 5 compounding periods in 5 years. Our present value is negative 7,000. It's negative because we're purchasing a CD, and that's a cash outflow from the decision maker's point of view. And we want to solve for the future value at the end of 5 years. We go to Formulas, Financial Formulas, and scroll down to find Future Value, FV. In the dialog box, we put in our 6% rate, number of periods, 5 periods, and our present value, negative 7,000, and we got our solution, $9,367 and change. Let's move on to present value. The firm's investment and financing decisions require valuing real assets and financial assets. Discounted cash flow valuation calculates the value of an asset as a present value of its future cash flow stream. Discounting is the opposite of compounding. Discounting moves a future value back in time to determine its present value. It determines how much $1 tomorrow is worth today. It answers the following practical question. How much must I invest today to have some specified sum at a future date? In the previous lecture, we considered the present value of a future value over a single period. Now we want to consider the more general case of the present value of a future value over multiple periods. We begin with the standard future value equation, which we'll now call the time value of money equation, and we'll solve for present value by dividing both sides by 1 plus r raised to the tth power. And we get the standard equation for present value, where present value is equal to the future value in year t divided by 1 plus r raised to the tth power, where r is the interest rate per period. When moving a future value back in time, it's also called the discount rate. In discounted cash flow valuation, the appropriate discount rate is the opportunity cost of capital. 1 plus r is raised to the tth power, where t is the total number of periods over which the cash flow is discounted. We can rearrange the equation to get another version of the standard equation for present value, where present value is equal to the future value in year t times the present value factor at r% for t periods. Now let's look at an example. How much must I invest today at 9% to have $10,000 5 years from today? In year 5, we have a future value of $10,000, and we want to discount that back 5 years to determine its present value. We'll first calculate its present value using the standard present value equation, where present value is equal to a future value times the present value factor at r% for t total periods. We have a future value of $10,000 multiplied by a present value factor at 9% for 5 periods. Doing the math, we have a present value factor of 0.4699 and a present value of $6,499. So if $6,499 is invested today at 9%, we can create a future value of $10,000 in 5 years. Now let's solve the problem using a spreadsheet, and let's input our values. We input 9% into rate, 5 into number of periods, and we input a positive $10,000 into future value, because the $10,000 would be a cash receipt from the investment and therefore a cash inflow from the decision maker's point of view. The spreadsheet solves for the present value and gives us a negative $6,499. Negative because we're making an investment at time 0, and this is a cash outflow from the decision maker's point of view. Now let's go to the spreadsheet. How much must I invest today at 9% to have $10,000 5 years from today? Our rate is 9%. Rate can be input either as a decimal or as a percent. Let's input it as a percent. Number of periods, we're going to discount the future value back 5 periods. Our future value is $10,000 5 years from today. I'll input that as a positive $10,000. Positive because the $10,000 is a cash receipt from the investment and therefore a cash